Hey everyone, Ryan Bolton here, local mortgage expert. Today we're doing a Q&A video where we're going through and answering some of the questions about buying a home, about mortgage financing, all those fun things. So we're going to go through and answer some of those questions. If you have any questions, please reach out to me or put a comment in the section below and we'll get to those questions in a future video. But I really enjoy what I do for a living, really enjoy helping people buy real estate and know the ins and outs of what it takes. So let's go ahead and answer a couple questions right off the bat here. One of the first ones I saw here is, what is the benefit of working with a licensed mortgage broker for home buyers? One little soapbox thing I want to say here is, do not work with someone that's there is a system in place, the National Mortgage Licensing System. So you'll see that even on my video down here in the corner, you're going to see this little number, this NMLS number. That's my license number. That goes with me no matter what state I'm in, no matter where I'm going. That way I can't just commit loan fraud in, say, Mississippi and then move out west or vice versa. That number is something that's a national register, a national licensing system. Then each state will have additional licensing requirements or continuing education or certain things to be able to get that license. Now, I've been doing home loans since 1999. When I first started, there wasn't any licensing at all in the state of Utah or Nevada. And over the years, after '08 and after just years and years of issues and complaints, they came up with this licensing system. And it's really a universal, it's a universal system. So you have your individual mortgage license, then the mortgage company you work for also has this number, and that way there's some sort of accountability, there's some way to be able to take people's licenses away or make sure that they don't just commit fraud in one state and move to another state. So, and there's yearly requirements to retain your license, so you can't just get out of the business and then start right back up without going through the continuing education and retaining your license every single year. So the question is, what are the benefits of working with a licensed mortgage broker? Well, first, make sure they are licensed. Don't use a loan officer assistant or somebody else that isn't licensed that's representing somebody else's license. We see this happen a lot. Now, that doesn't mean there's not processors and loan officer assistants that can gather paperwork or get your pay stubs or W-2s or maybe answer certain questions, but they shouldn't be quoting interest rates or doing really explanation of certain programs you qualify for. That's the job of the loan officer, but they can help with clerical duties. They can help with gathering paperwork, those types of things to help your file move more smoothly. I mean, they'll deal with the insurance agents, maybe the title company, the appraiser. There's definitely teams that work on getting your loan done, but really most of the rate questions and program qualifications, that really falls on the head of the loan officer to explain those things to you. The benefits of working with a mortgage broker versus maybe a mortgage lender or a direct bank or something like that is usually a wider range of programs that they have access to. More mortgage brokers are going to say yes more often. Now, maybe the rates are going to be different because it is something where most of the mortgage brokers are going to have programs that the bank's not going to have. They're going to have maybe a client that's been self-employed or has maybe credit issues or debt ratio issues, stuff like that, where they don't fit in that cookie cutter perfect little A paper box that a lot of banks want to deal with. So credit unions, banks are great. Their money's really cheap, but their requirements are a lot tougher. They take a lot longer. Not everybody qualifies for those types of loan programs. So typically mortgage bankers and mortgage brokers are going to have more options, more ways to shop your loan, maybe better rates depending on your situation, and usually a little more experience about all the mortgages that are out there, knowing which ones you'll actually qualify for. So that's really comes down to expertise. And I will tell you this, just because they have mortgage broker behind their name doesn't mean they're any better. It really comes down to the person that's doing the loan for you, their experience, how long they've been doing it, the type of loans they do. There's so many mortgage loans out there. First, seconds, reverse, construction, refi, purchase. Not every mortgage broker, every person is a specialist in all of those types of loans that you need. But it is something where working with the person, interview the person you're working with as much as anything else. And again, make sure they're licensed. All right, let's see if we can jump on to another question here real quick. How do the rates for a 30-year fix compare to 15-year rates? So there used to be a really big separation between a 30-year fix and a 15-year rate, but now that the bond curves and everything have really kind of tightened up, you're not seeing a massive difference between those two. Now it is cheaper, but the payment difference is dramatic. Going from a 30-year to a 15-year can be a dramatic jump in the payment, but over the course of that loan, you're going to pay a lot less in overall interest. So usually what I tell my clients to do is set the minimum at that 30-year rate, but pay the extra to make it to where if you lose your job or something happens, you kind of have that smaller payment to fall back on, but discipline yourself to pay the extra as if it was a 15-year term. What I see people will do is they'll want to do the 15-year term. They want to retire in 10 years or whatever it is. So they really want to accelerate all this money towards their mortgage. But then something happens, Christmas comes around, something happens medically, and they have such a large payment, it becomes more of a financial burden to make the minimum than if they can just fall back onto that lower payment. But notice I said discipline. Many people, they get the minimum payment on a mortgage. That's all they pay. They never pay any extra. They'll be paying that loan for 5 years and very, very little principal reduction during that first 5 years on a 30-year loan. So there's a benefit with the 30 and a 15-year. There's disadvantages with the 30 and a 15-year. But usually when I'm sitting down with my clients, we look at that 30-year option, we look at their savings, retirement, other things that they're doing and say, okay, let's do all of it. Let's pay down the mortgage, sure, but let's also make sure your savings is being increased. Let's make sure the reserves are increased. Let's make sure that you're contributing to a 401 or IRA. I mean, there's really a lot of vehicles out there. There's some insurance products that are getting really aggressive that may even be safer and better rates of return, don't have the fees that 401s and IRAs might have. So there's other things out there that you want to look at. It's great to have the mortgage all paid up, but you got nothing in the bank. That's not a safe retirement either. You got all this equity you can't even get to. But at the same time, having everything in the bank and still having a high rate on the mortgage. So you want to have a balance of those two things. So just like any loan program, there's benefits and disadvantages, but knowing how they work and sitting down with your loan officer and not only looking at just another mortgage, but looking at the entire financial picture will give you a much better loan for years to come, years and years. So what is the goal? Are you trying to retire soon? Is this just a quick, easy home, maybe your first home, and you're going to have kids and get out of school and maybe you'll sell in 5 years or 10 years? Is this your first home, last home? All of these things really will give us a better idea how to answer those questions for you to make sure that this is the best possible loan. Now, stuff happens too. Maybe 5 years down the road, something happens with the kids or something just changes, life events happen, and that home ends up being something you need to sell. You get relocated with your job. I mean, stuff does happen, but I think too many people really try to accelerate the mortgage without also looking at ways to take that same extra payment and put it into savings, emergency, reserves. There needs to be a balance where that money ends up going because you have a certain amount of money to work with. You want to maximize it. Throwing everything you got at a mortgage, I don't think is the best way to do it. So let's talk. If you're looking at buying or refinancing a home in Utah, Nevada, that's where I'm licensed, and I can help you walk through some of these ideas. All right, let's see what else we got. I try to keep these videos about 20 minutes long, so we're about 7-8 minutes here, so let's see what else we got. Let's see. How do I avoid losing my house because my mortgage payment has doubled? Wow. I'm not sure why it would double. You want to definitely double check the reasoning behind why a payment would double that much. There really hasn't been a lot of adjustable rate mortgages over the last few years, so it'd be surprising if that's the reason it doubled. Now, property taxes can go up, so you might want to see if maybe your escrow account for some reason really went up. Maybe there's an error on the insurance or the property taxes or something changed there that maybe you're able to dispute and find out why the payment's gone up. But generally speaking, you're not going to see the actual mortgage go up double. Now, the housing expense might go up because of taxes, insurance, HOA, something like that can change. But generally, mortgage payments don't double. They really don't double. And I see a lot of times when this happens, usually it's some change in the property taxes. Like in our area, there's a deduction if it's a primary residence. There may be a deduction if you're a veteran or disabled or a certain age. And sometimes that deduction might go away because they think maybe you've moved or it's not your primary residence. Or there's a lot of this around the country where there's different tax rates. And sometimes that reverts back to maybe the top rate when you still qualify for a middle or a bottom rate. So generally, when I get people calling me in Utah, our taxes are due in November. I'll start getting people calling me the 1st of January. Hey, my mortgage payment's gone way up. And sure enough, a lot of times you look at the escrow payment and that's been adjusted. So check that first. But when you see a big jump or big change in your payment, especially if it's a 30-year fixed, the escrow account is usually the issue. And it's usually a way to go back and go to the county assessor's office or the recorder, treasurer, whoever it is, and get those things adjusted. Next one, why would a landlord refinance? Better terms. Maybe they have an interest rate that was higher and now they can refinance. Maybe they're trying to pull out some money to do some other investing or repairs on other things. I mean, just like anybody else, it doesn't matter if you're a landlord or just a regular homeowner. there's obviously some benefit to refinance or some need for maybe some additional cash. So maybe this landlord had an adjustable rate mortgage, or maybe they had a higher rate. Maybe they bought the property at a with mortgage insurance or something like that. Now they can drop those things off with a refinance. So the refinance, that's really probably one of the more common things, just to change the payment, reduce the payment, pull out cash, something like that. All right, let's see what else we got. Let's go to a different section here. I got a couple fun ones here. The real estate investing. I hope you enjoy these videos. I really enjoy doing them. If you have any questions, comments, concerns, please post them. If you have any topic you want me to go into further detail on, I'd love to talk to you there. Let's see. How do people afford a $700,000 house? That is all relative. I mean, they make the income. They have maybe enough to where they're putting a large down payment, so they're not borrowing the whole $700,000 for the house. So a lot of it will just come down to their income, their assets, their other debts have what's helped them afford that house. And maybe also at the time, maybe the rates were a lot lower than they are now. I think this question's popping up a lot more, where people are seeing the payments now at some of these $500,000, $600,000, $700,000 houses and going, man, I can't afford that, because that payment has gone up so much. So really, how can people afford it? They can afford it. They have enough income that can offset that payment, or they have enough down payment from selling another home, or they have other fixed income sources. Two family, husband and wife both work and they can afford it. There's just, it comes down to being able to make the payment. Let's see. What is the most common type of real estate agency? Oh man, I don't know what the most common type of real estate agency. There's real estate agents. There's the real estate broker, who's kind of the top agent, if you will, or kind of the person that's in charge of governing and monitoring the other licensees that are under that person. So what's the most common type of real estate agency? Probably real estate sales. I mean, that's, or you got property managers, or technically a real estate agency. That's an interesting question. Okay. What else we got here? When do you lose money on an investment property? Cash flow, cash flow, cash flow. So when you lose money is if you have the debts to maintain taxes, insurance, HOA, any mortgage payment, any repairs, that type of stuff is more than what you're actually getting for the rent. So when do you lose money on the investment property? Honestly, most of the time it's earliest on. Like the most expensive part of a real estate investment is on the beginning stages, because that's usually where you've got the highest debt load versus what the rents are at that time. But over time, usually that debt load can go down and the rents will go up over that time frame. Or you'll see interest rates be cheaper where they can refinance and lower that cost basis. But really, when you lose on an investment property is the difference between the debt servicing and what you can get for the rents. So let's say there's an area that has maybe really heavy in one industry. Maybe they've got a mine or the car manufacturer, or something that's maybe heavy in a certain area that relies a lot of jobs on that particular industry, and it goes away or starts to see a downturn, then all of a sudden you've got a lot more investment properties that become cheaper to rent. And so rents start to go down, or maybe there's a lot more rental properties than renters that move into a certain area, or they're moving out. I mean, there's a lot of factors that go into what affects a rent price or a home price. But generally speaking, that's when you lose money, is that difference between debt servicing and what you can get for the rents. The vice versa is, as if the property values go down dramatically for whatever reason, then that's when you can see some loss on investment properties. But generally speaking, they're a longer term investment. I think our society's gotten way too quick at just this quick turn, quick buck, get rich, whether it's cryptocurrencies, whether it's anything else like that. There was this idea you can just really make a lot of money really quickly, where real estate was a safer investment and usually a lot more long term. Homeowners win in the long run. Long term, they'll win in the long run, but it has just slowed, like what you can make, and that the cost of getting money right now is more. So then that's why you're also seeing the cost of rents going up. But it's something that's where you're going to lose on investment property, or even non-investment property, any property. That's how you can lose on it, is the cost to have it is more than what you can rent it for or what you can sell it for. All right, let's jump into, let's just do general real estate questions. Ooh, creative financing. Oh, that's interesting. Here's a good. Is 3.25 a good mortgage rate? Compared to what? Yes, 3.25 was giving money away for years. But if rates are 1.25%, then 3.25 is not that great. Today, that's bonkers good. That is absolutely ridiculously great. Compared. It's compared to what? Compared to when? All right. What What other questions do we have here? Oh boy, trying to get that lights right in the way. Oh man, I sure love talking about this stuff. I don't know what it is. I've just been doing it for a long time and enjoy helping people. And let's see, let's see. Can my house be foreclosed if I own it? So no, there's no lien against it. Foreclosure is when a lender isn't getting their payment and the collateral is the house. So you can't really get foreclosed on if there's no lien against the property. Now you could lose the house if you don't pay the property taxes or if a judgment shows up or something else tries to go after your asset. But foreclosed is typically a default of an obligation that's tied to the home. So I have people tell me all the time, well, you're just renting it from the bank. You really don't own it. The bank owns it. That's not how mortgages work. That's not how car loans work. They're collateral. The home is collateral that the lender says, hey, if you don't make your payment, I'm loaning you this money to buy it or refinance or whatever you're doing with the money. If you don't make the payment back to me, I've got some way of recouping my investment by taking back the home. Now, there's a crazy process to start foreclosure. There's notices and waiting periods and all kinds of stuff. And most lenders, they're not in the business of taking the home back. They're in the business of loaning out that money, getting a rate of return, that type of thing. So they want to keep their foreclosures at a low percentage. They don't want a lot of foreclosures, obviously. And we're not seeing foreclosures really increase. The reason we're not seeing foreclosures increase like we did in 2008 is most people have a home house payment that's cheaper than if they were to sell the home or go into a rental situation. So they're better off just keeping the house. So you're seeing that foreclosure rates are dramatically low because people don't really have an alternative. They don't have a cheaper house they can go move into. They don't have a cheaper rental situation. They're better off staying where they're at. They'll start missing payments on everything else, like cars and other things before the home payment because they don't want to be homeless. They don't want to lose the house. They don't want to have to go into a rental situation. So we're really not seeing foreclosures increase at all. And that's also not adding to our inventory. I mean, foreclosures are a natural part of home lending and the real estate market. In fact, there's actually an index that says if we don't have a healthy number of foreclosures, we've done something wrong. So it's really interesting looking at that index that our foreclosure count's actually probably too low because it's also not adding to the inventory. And there's all kinds of reasons why people get foreclosed on. It's not just loss of job. It's not just there's lots of reasons why that still happens. But the short answer to this question is, can my home be foreclosed if I own it? No, but it could still be taken away for other reasons. But foreclosure is not the word that would be used because you don't have a loan against the property. So, and just to go back a little bit, kind of clarify it as well. The collateral is the house. They don't own the house. The mortgage lender and the mortgage loan officer can't walk up to your door and say, hey, we have a loan against this property. We need to borrow it for the weekend. We want to jump in your pool. Wouldn't that be amazing? The loan officer just shows up and say, well, we did your loan for you a couple of years ago. Remember that? I need to use your pool this weekend. It doesn't work. That they don't own the house. They just have a lien. They have collateral against it that if you don't make that payment, that's what they take back. But they don't actually have ownership of the home. All right, let's see what else we got. Hi, I'm your loan officer. I need to use your restroom. I really like your kitchen. I'm going to make some cookies. That's funny. They don't own your house. I hear that all the time. They don't own your house. Your car loan. They don't own. You're not renting the car. You own it. It's collateral. It's not ownership. All right. Let's see. I just put an offer on a house and my neighbors came out and were horrible. Oh, I've had this happen all the time. How many people out there, raise your hand, that have had just bad neighbors for whatever reason? I said the seller accepted my offer, but now has a bad taste in their mouth. What should I do? Should I back out? Well, I don't know. I don't really. It's a lot of the contract is to protect buyers a little more than sellers. To be very honest with you, a lot of the outs are more for the buyer side. So if you're a seller and you have a contract on the home, until some of those deadlines expire, you're under contract. There's really nothing unless the buyer doesn't do something that you can get out of the contract. So just to clarify that, maybe that was mistyped on this question, but I tell you what, neighbors can be deal breakers. I mean, they really can. I remember one client. Utah is a little different than even California, Nevada. It's a weird thing. Our trash cans, they don't have all these rules about putting the trash can kind of behind the house, behind the garage. Usually they're just on the side of houses more in Utah. I'm not sure why that is. And I've had a lot of people that have moved into this area and they said, why is the trash can? You can see the trash cans, even though they're maybe by the side of the house, side of the garage, maybe pulled up onto the curb. I don't know why it is, but Utahns just don't seem to care as much about the trash can being more visible. Now, some people do. They want to make sure they're behind a gate or something like that. And they really hated the fact that they looked around the neighborhood and they could see trash cans, even though they weren't like on the street or in the driveway. but they just they caught their eye, and they had the hardest time even buying in almost a lot of the places in Utah because they could see the trash cans. But neighbors neighbors can be deal breakers. I mean, it is what it is. I mean, that's something where if a seller is trying to sell and the neighbor just comes out and says something weird to your potential buyer, it may scare them off. That's what could happen. So I don't know what you can do is other than just timing at different times, or maybe be there when the agent shows up, or have the other agent there. I mean, I tell you what, agents are pretty good at scaring off, jumping in front of a neighbor that happens to show up, especially if they walk up all aggressively. And so that's where having an agent can help you a lot, if they actually show up to listing appointments or show up to the situations, because they know there's just bad neighbors out there, and that's just the course of humanity. All right, what else we got? How are we doing on time? Ooh, we're hitting the 20-minute mark, so let's see if we can find one more doozy. Again, if you have any questions, comments, please post them below. Really enjoy having fun with these videos, so let's see what else we can do. Let's see. How often should one refinance their home or buy a new home? Boy, I tell you, refinancing I think is going to be really slow for the next few years, just because the benefit to refinance has really dramatically gone away, because most people have a lower rate than what's going to be available for years to come, probably years and years before refinancing really is going to kick up at all, versus buying a new home. I think buying a new home really comes down to your needs. If the home fits your needs, you really don't have to look at buying a home. But if you're outgrowing it, or the neighborhood, or need more yard, or you got more kids coming, or income changes and you want to be able to do more, maybe you have an HOA, you're in a condo and you want to upgrade to a single family home. So really buying a new home, I think, comes much more down to your needs and wants than it is just, okay, it's year 5, 9, I need to go buy another house. Really very rarely do you have somebody that just has it on a clock, or just a time frame where they always should refinance every year, or refinance every 3 years. Or we saw a lot more refinancing in the last 10 years than we have probably in the last year, because the benefit to do either pulling out the cash, lowering interest rates, getting rid of mortgage insurance, there was more benefits for refinancing. But now the rates are higher in such a relatively quick time frame. Most people that are doing their loans are, at this rate here, that are buying, the people that currently own are down here. So there's no reason for them to jump up here for a refi. So I think refinances are going to be historically slow for a long time, because unless we just see some dramatic collapse in interest rates, which that's all crystal ball at this point. But it really shouldn't be a time frame where, okay, it's year 2, I need to refinance. If it's a benefit to refinance. Get rid of the mortgage insurance, lower the rate, pull out cash, whatever that benefit is. As far as buying a new home, again, as your needs and situation changes, that's when you look at buying a new home. So hope all these are interesting to you. Let me know if you have any questions, comments, or concerns. I lend in the state of Utah and Nevada. Patriot Mortgage. We also loan in many other states. So if you need any help with any state, I'd love to help you. I do a lot of things for free for my clients, just giving them quotes, giving them advice. I've been doing this a long time. I really do want to just help. I don't have to sit here and try to close every application that comes into my office. I really want to help. I love doing real estate. I own real estate. I buy properties. I sell them. I do a lot of things within the real estate financing world, and would love to share my expertise with you and go through any questions you might have. So appreciate your time watching this whole video. Let me know if you have any questions, comments, or concerns, and we'll see you on the next one. Thanks.